Let's take our market discussion forward with our guest joining us on the show, Mr. Satya Narayan Bansal. He's the head of wealth division at Barclays India and gets us a perspective about the ultra high net worth individuals and HNI. How are they positioning in this kind of a market? Mr. Bansal, good evening. Thanks a lot for your time. Before we talk about the approach of the HNIs, let's understand at your desk what's the investment hypothesis you are making and hence recommending your HNI client base both in India and abroad?
Let's understand this from two perspectives. One is from local investors in India and second is global investors who are looking at India. Both of them are looking at it with two different lenses. So far, a local investor concerned, I think there are three broad asset classes they have been constantly putting their money, evaluating it: real estate, equities and debt. Real estate as an asset class for the moment, I think it seems little illiquid in many client portfolios, and obviously they are looking to get some liquidity out of it at the moment. So far as the debt is concerned, that's an asset class which has really done very well, and we see right now a significant amount of overinvestment in that asset class, which at some point in time will face some amount of reinvestment risk as rates come down, and it remains little. It becomes a little unattractive from a yield and carry perspective, and that's where I see a significant shift happening a year down the line, 15 months down the line, to growth asset class like equities, because real estate still has got its own challenges, headwinds to really manage. If that be the case, I think currently the way we look at the investment is real estate, because the historical investment which they are trying to still encash, debt and equities. This is the current shape of the portfolio. I believe the portfolio eventually will have some bit more of equities, less of debt, and real estate to the extent they can't really liquidate or they can't really encash.
Satya, give us an idea also about the concerns when it comes to demonetization, the economic slowdown, the impact on markets. Do your key clients probe you regarding this, and if they do, what's your answer to them?
See, demonetization has got two parts to it. One is what is happening of this on this whole black money thing and demonetization being used as a tool. I believe there would be some amount of impact in the near term economy. But if you really ask me what's going to be the long term shape of the economy, I think this is going to trigger a significant amount of cashless economy, and the outcome which is going to lead is going to be far more positive and far more sustainable than the short term pain that we keep on discussing currently. So far as the high net worth and ultra high net worth client families are concerned, I think they see this as a good opportunity for market to take benefit in the medium to long run, and I think the current bit of volatility in the market is also being used to strengthen their equity position in the market.
Okay, and do you think that there is an opportunity in the upcoming union budget presentation on the 1st of February for the finance minister and his government to address growth concerns in the economy?
It's difficult to predict what's going to come in the budget, but what we are largely seeing out of the recent moves of the Modi government is that this budget is going to be very growth oriented, and it's going to focus a lot on job creation. And if we see the recent statement from the Prime Minister, one of the possible push in the budget could be housing for all, which is already the intent has been made clear, but we see a significant amount of allocation happening. Maybe this particular demonetization phase will also give some amount of financial headroom for them to push that in a big way. So be it urban mass housing or be it rural housing, I see a significant amount of opportunity to come in the budget. Overall, the budget is likely to be growth oriented, and I think it's going to be positive for the market and the economy as a whole.
Satya, what kind of road ahead do you see for equities in terms of returns, the Indian stocks in terms of returns, if one were to talk beyond the 6-month, 1-year period, which is likely to come under a cloud of slowdown? Otherwise, how do you see the returns over the next 1 to 2 years?
So, it's difficult. Equities do not really follow a trend to grow on year basis, but on the whole, we have seen that Indian equities have given returns anywhere in the range of 12% to 18% in any any 10-year horizon that you see. And I believe that we are going to still have a return similar to that, although our inflation is going to be little lower as what we have seen in the past, so it may get little bit moderated by a couple of percentage points, but we still see that the equities market will give closer to anywhere from 10% to 15% return, and which is very good, because given that we do not have tax on the long term capital gain, it almost works out anywhere from 15% to 22%, which is much higher than many of the high yield instrument can give in. However, it requires a bit of patience for investors to hold on, and someone has to have that 3 to 5 year horizon to hold the equities and to take advantage of the whole structural economy and the positivity to play in the economy.
Satya, when you interact with your global investors, though India is just some part of their overall portfolio, generally what are they saying about Indian markets, and are they willing to allocate more funds here into Indian stocks in this environment which you have spoken about?
So, when we interact with some of the global investors, we see couple of patterns emerging in their overall global portfolio. By the way, they are not as biased towards India as we as an Indian investor could are. So they are right now, I believe, they are right now overexposed to developed equities and overexposed to emerging market bonds, and many a times levered position on emerging market. So that is their overall global portfolio. Now within that they have very small India allocation right now, but I believe that the way that the overall structural reforms are playing in the economy, the various, you can say, the positive messaging which is happening around economy, and this demonetization which has been taken very positive by global investors, we see a larger amount of their allocations to happen to emerging market, especially to India, given that they are still not so much convinced with some of the other competing emerging markets. The BRICS basket, I think the eye stands very, you can say, bolder or very much more stronger than rest of the BRICS countries and the emerging market as a whole.
Satya, final question to you in light of what you just said, especially about global equity markets. What are the risks the HNIs, the investors should keep in mind?
Markets are volatile, so someone has to have a very considered view before you take any position in the market, and please don't go by the happenings which is on hourly or a daily basis. And that's one of the risks that investors have to keep in mind. However, the bigger risk which I see from an Indian client perspective, Indian high net worth and families perspective, they are carrying a significant amount of reinvestment risk in their debt portfolio, which means a year down the line when the yields are going to be much lower than what it is, the carry on debt would not be as attractive, and at that stage they will be forced to look at growth investments, be it equity or real estate. Given the current state of real estate market, I think the choice would be to go more towards equities. So at that time they will be forced to get into equities. Now they have a choice to make whether they would like to get into growth asset like equities today when you have clear choice to make, or you will be forced to get into those when you don't have much choice to make, and debt would not be that attractive anymore. So far as global investors are concerned, I think they are grappling with couple of big events in the global market. One, I think they are concerned about what's happening with the Italian banks. There is a bit of concern with the overall state of the banking system over there. They are equally concerned about what's happening in China, particularly that they have seen that China's debt to GDP is almost upwards of 250%, and the government recently coming up and putting some brakes on outflows. So that does not give them a very good comfort on the state of economy over there.
Find us on Facebook at facebook.com/ETNow, and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.